If you're carrying a significant amount of debt, particularly credit card debt, you know how frustrating it can be to make monthly payments that barely make a dent in the balance. Interest rates on credit card debt can be as high as 20% or more, making it difficult to make real progress on paying off the debt. Fortunately, there's a way to potentially pay off high-interest debt more quickly and save money on interest payments by taking out a loan from your whole life insurance policy. A whole life insurance policy is a type of permanent life insurance that provides a death benefit to your beneficiaries while also building cash value over time. Let's explore how you can use this cash value to pay off debt. First, it's important to understand how cash value works in a whole life insurance policy. When you make premium payments on a whole life insurance policy, a portion of the payment goes toward the cost of insurance, while the remainder goes toward building cash value. Over time, the cash value grows tax-deferred, meaning you don't pay taxes on the growth until you withdraw it. Once you've built up a sufficient amount of cash value in your policy, you can take out a loan against the cash value. This is known as a policy loan. Unlike a traditional bank loan, a policy loan doesn't require a credit check, and you don't have to pay it back on a set schedule. However, you do pay interest on the loan, which is typically lower than the interest rate on credit card debt. By taking out a policy loan to pay off high-interest debt, you can potentially save money on interest payments and pay off the debt more quickly. Here's how it works. Let's say you have $20,000 in credit card debt with an interest rate of 18%. If you make the minimum payment of 2% of the balance each month, it will take you over 30 years to pay off the debt, and you'll end up paying over $65,000 in interest alone. Alternatively, you could take out a policy loan of $20,000 from your whole life insurance policy. Let's assume the interest rate on the loan is 5%. If you make monthly payments of $400 toward the loan, you would pay it off in 5 years and 5 months, and you would pay a total of $4,682 in interest. This means you could potentially save over $60,000 in interest payments by using a policy loan to pay off the debt. Of course, there are some risks and drawbacks to consider when taking out a policy loan. First, if you don't pay back the loan, it will reduce the death benefit that your beneficiaries receive. Additionally, if the policy lapses or is surrendered, any outstanding loan balance will be deducted from the cash value, potentially reducing the amount you receive. Furthermore, it's important to understand that taking out a policy loan is not a silver bullet solution to debt. You still need to address the underlying issues that led to the debt in the first place, such as overspending or living beyond your means. It's important to create a budget and a plan to pay off the debt over time, rather than simply relying on a loan to solve the problem. In conclusion, using a whole life insurance policy loan to pay off high-interest debt can be a smart financial strategy, potentially saving you thousands of dollars in interest payments and helping you pay off the debt more quickly. However, it's important to understand the risks and drawbacks of taking out a policy loan and to address the root causes of the debt to ensure long-term financial stability. If you're considering using a policy loan to pay off, thank you for watching the video.